We just put a 229 unit apartment complex in Plano, Texas under contract for 39 million. That's 6.5 million less than what the previous owner paid for it 5 years ago. And we're buying it at roughly 30% below what it would cost to build brand new today. Today, I'm going to break down exactly why we're buying this deal and what we plan to do with it and what the returns look like. Let's get into it. So first, the market. Why Dallas Fort Worth? What makes this the right market to invest in right now? For us, you guys, when we're looking to invest, we're looking for states that are very landlord friendly. That gives us control, right? If you come in and buy a business and you don't have control of evictions and being able to raise rent, you don't really have control of your income. You don't really control the business. So a non-starter for us is we're looking for states that are landlord friendly. We're looking for business friendly, and we're looking for job growth and population growth. And as long as we have those main drivers, we'll go and take a look at these submarkets. Now, that doesn't mean you buy in any submarket in Dallas or Fort Worth. Definitely not. Not every submarket is created equal. You know, I get the question a lot, hey, should I buy this deal in this submarket? And it's like, I don't know. I don't know that submarket. You got to figure that out. That's what a savvy investor does. But some of the things we're looking for in a very strong submarket, which is why we are buying Hathaway at Willow Bend, is the 1 mile median income. You know, well, this is a 105,000 1 mile median income with an A school district rated on niche.com. And it's one of the top school districts in the country. It's actually ranked one of the top in the country. You put that with the 1 mile median income of 105,000, plus you put some of the hottest, most attractive retail right across the street. Whole Foods, Williams Sonoma, Sephora, La La Land Coffee, all of these hit places, and it's where people want to live. And what ends up happening, you guys, this is really interesting, is the average income can't support living in a submarket like this, right? The average home price is 700 to 800 grand. And so what happens is it prices out many people. But if you own an apartment that's a B-class apartment like Hathaway at Willow Bend, it makes residents who can't afford a home very aggressive to want to rent an apartment because now their kids are attending one of the top schools in the country, in the city. They have retail right across the street. Crime is low, a very safe, beautiful place to raise a family. So that effect makes tenant profiles living at these apartments very long. Like when we did our lease audit, we saw leases for 7, 10, 15 years. That's because of the location. If you're sitting there making good money, whether that's W-2, business income, whatever, and you feel like you should be further ahead than you are, it's probably not an income problem. It's a structure problem. I put together a free blueprint that breaks down exactly what I mean by that, and it covers the 3 tax buckets, why most real estate actually fails as a tax strategy, and the capital framework I personally use to evaluate where money should go as income grows, and it's completely free. Links down below. And you know, another piece we're watching, you guys, is where's the #1 location for one-way trips with U-Haul? And Dallas Fort Worth was ranked the #1 U-Haul growth market for 2 years in a row. And what does that actually mean for us as multifamily investors? All that means is that people are going there. Jobs are going there, right? And the things that are happening in some of these other states, these blue states, I'm not going to name names, are very scary for these business owners, and they're relocating to Texas. And so as these business owners relocate to Texas, that has people following. And that's why U-Haul's #1 growth market for 2 years in a row is U-Haul. DFW is ranked #1 for 2 years in a row with one-way trips from U-Haul. That just tells us people are going there, right? You got a lot of things happening in a lot of these markets in these different states on the East Coast and West Coast that are very unstable for business owners. So a lot of these businesses are transplanting to Texas because it's a business-friendly state. It's very safe. They can predict income. They can control their taxes to much more extent, and that causes people to follow those job relocations. You know, a lot of people say the market is oversaturated with new apartments, and you know, the reality is that was true back in 2021 and 2022 with these new starts. And that was true for many cities around the country. And what's happened lately is that new supply glut has pushed rents down and values down because all of the absorption needed to happen over the last 2 to 3 years. And what's happened is there's very, very little supply coming compared to what has hit over the last 3 years. And so new supply specifically is dropping off a cliff. And when that happens, mark my words, it's going to put pressure on rents, because rent, just like anything else in the world, is controlled by supply and demand. And if there's not enough new supply coming, it puts pressure on the rent for the units that are already there. And the piece you guys want to look into with anything you're buying when it comes to apartments is, what is your submarket like now? What is the occupancy like in that submarket, and how many new builds are coming? We like to get into submarkets where you have extreme pent-up demand, right? We can find 95% occupancy, and we can see that there isn't any new builds coming. So if we can get into a submarket like that with not any new builds coming, we've got a very good chance of being able to drive rents higher, because they're already in a state where there's just not enough places for people to go. Something else that's worth discussing, only 28% of households currently qualify for a mortgage on a median priced home. And so what that does, it creates an affordability gap. An affordability gap just means in order to own a home versus rent, there's a big gap in between there. And people just simply cannot afford the price of a home these days with where rates are. So they're forced into being renter. And unfortunately, or fortunately, depending on which side you're on, America is moving more towards a renter's nation. I want to walk you guys through the deal a little bit of why we're buying it. So again, we're getting this deal for $6.5 million less than what the sellers paid in 2021. And the way we found this deal, you guys, is our team underwrites hundreds of deals a year. At Granite Towers, I think last year our team looked at 320 to 340 deals. Now that doesn't mean we went super deep on all of them, right? They probably only spent a half hour on most of them, but for the ones that started to gain legs as we did our underwriting and we're communicating with the brokers, we went really deep on. And our team spends day after day analyzing, looking for the best deal that fits our specific criteria. Criteria is really great, you guys. If you don't have clear criteria, it helps you say no to deals and helps you from getting caught down rabbit holes of things that just will not perform. And it gets it in a position where you can look at a deal and within 30 seconds say yes or no to the broker. And as these brokers that are sending you deals, they'll get to know what your buy box is, and they'll design it more efficiently so that you're getting things that you're more interested in. But that's how we found this deal. A piece, you guys, again, that I just want to double hit on is there's 0 new multifamily deliveries projected within 2 miles over the next 2 years here. And the reason, again, that's important is because rent is controlled by supply and demand. If there's not enough places for people to go, rent will go up. Occupancy goes up. And as occupancy climbs, people go for higher rents. That's just the name of the game. The median household income, you guys, again, within 1 mile, it's over 105 grand. The average home value is 775 grand. That tells you that not a lot of people can afford homes in the submarket that would love to live there. And so that's why you have constant pressure on units in this submarket. Here's our business plan, you guys. We're converting 62 units from a 1-bed, 1.5 bath into 2-bed, 1.5 bath. And the strategy there, we've done this many times on many assets, is you put up a wall. And when you put up that wall, now you got a bedroom. Now you can charge $150 or $200 more for that unit. For comparable renovated properties nearby, they're getting about $200 more per month. And so the question is how confident are you that you can hit those numbers? And what happens is first you go and shop the submarket and you verify what the rent is based off of the finishes of the interior of these assets, or based off of what the amenities are like. And you can see pretty clearly about what you can get for rent. But the best way to verify that you're going to move rent up $200 is by getting it on the property. And so Hathaway at Willow Bend has a bunch of units already upgraded and they're getting $200 more. So come in and finish the renovations and it gets you another $200 per rent. When you've proven it out on the property, that's about as certain as you're going to get that you're going to be able to do it as you continue to complete these units. We've got 28 units that are already priced at or near our pro forma target. So we've got a chunk of properties already basically at what we're looking to get. So that helps us also have confidence in it being able to hit our pro forma rents. And again, pro forma rents, for anyone that doesn't know, that's just what we're projecting. It's what our rents are planning to go to in year 1 and in the future. As far as our renovation plan, beyond the unit conversion, you guys, we're going to be painting the exterior. We're going to be putting rock around all the chimneys. We're going to be doing a bunch of landscaping for curb appeal. We're going to make the asset much more inviting and match the competitors in this beautiful submarket. And if I want to break down the numbers for you guys, we're offering a 7% preferred return. And all that means is 100% of cash flow first goes to the LPs, or the limited partners, or the passive investors. And after we get 7%, to the limited partners. Then after that, it's split 80-20. And the 20 goes to the general partners, the people putting the deal together, and 80% of the cash flow continues to go to the limited partners. And so we're projecting just under 85% total return over a 5-year period, which is right around a 16.9% average annualized return and right around a 15% IRR. The financing, you guys, for this is a Fannie Mae fixed rate loan for 5 years. We lock it in. The rate could be right around 5% or so, as we've had some treasury run. And it's important to understand that distributions are scheduled based off of cash flow. And again, the only way that the general partners team starts to see some cash flow is by overperforming on the 7% preferred return. It really aligns our limited partners to put them in front of what we'll make as limited partners. And the piece that also is important to understand is after we get 16.92% to our investors, now the split goes to a 70-30 split. So we're heavily incentivized as the general partners to overperform on our 16.92% average annualized return in order to get that 70-30 split so we can get a little bit more on the back end. Some of the risk or downside protection, you guys, that I think is worth talking about here is we're buying this property about 30% below replacement cost. And that matters because the risk management tool we're using here is if things didn't go well, what do we need to do to get out of the deal? Collection loss is only 2% over the last 12 months. That means that people are paying on time. There's low delinquency. If rent growth doesn't hit our projections, what's the downside scenario look like? You're in a position where you've got a ton of CapEx that you're not going to spend. You're going to sit on it. You're going to wait. Now, in a market like we're in here where demand in the submarket is 95%. There's no new supply coming. Based off of the data, it's very, very unlikely that there isn't rent growth because supply and demand is going to continue to get more and more aggressively towards being out of whack. Biggest risk on this deal is not having enough CapEx. And we've been extremely thorough, walked 100% of the units, had 60 plus vendors on this property and said, hey, please tear the property apart. We need to know everything that's going on this property. And that's how we built our CapEx plan. So this deal, you guys, this is for accredited investors looking for a stable base hit, looking for a deal that will protect your downside, looking for a deal that will produce about 75% depreciation year one. Again, it's 7% preferred return, 85% projected 5-year return with 75% depreciation losses year one. If you want to learn more, click the link below.